A tradition unlike any other is again underway, the Masters. While the world's best golfers covet the green jacket, we're taking a closer look at the green golf can bring you in terms of an investor's perspective. Golf fans on Wall Street closely monitoring companies like Topgolf Callaway brands and Acushnet Holdings. Stephen's Managing Director Daniel Imbro joins us now. Good to see you, sir. So let's start with Topgolf Callaway. You have an overweight rating and a price target of $34, implying some major upside. Why?
Yeah, it's a great question, and thanks for having me this afternoon, Dave. I think when we think about the opportunity at Topgolf, it's one that presents, I think, two ways to win here. Within the core golf equipment business that this Callaway brand is known for, they've been demonstrating really a decade now of pretty stable share gains and really strong equipment rollout. That's been a very stable cash cow. What it's allowed them to do is continue investing in this acquisition of Topgolf and rolling out these units. I think when they look at the unit economics here, they're rolling out really stable cash-on-cash returns. I think it's going to be a self-funding type growth story by the back half of this year. And when you look at the consolidated kind of growth you're going to get here, 10 to 12% top line, high teens EBITDA growth, I think you're getting a really attractive multiple for a really attractive kind of growth asset and consumer.
How significant a game changer was the merger with Topgolf, and talk about their growth you project moving forward?
Yeah, it's a great question. It definitely was transformative. It went from a mid-single digit, maybe high single type story to a company that's going to grow top line at least in the low double digits for the next probably 5 to 10 years. So material driver, and from an investor standpoint, it's become a major focus of conversation and really what the main investment is here going forward. So definitely has changed it. On the growth profile, we touched on it there. Double digit top line, they feel very good about. You're growing Topgolf units in the high teens for the next 3 to 4 years. Those returns, like I mentioned, have been very consistent with an opportunity for kind of organic growth after the first few years. And so, we project a double-digit top-line CAGR at least for 5 years here.
They've even inspired several competitors, even different types of private company chains. For one, Putt Shack, they have 5 locations, but 14 more on the way. And the Tiger Woods-backed PopStroke has 7 locations already. Do you see acquisitions continuing to be part of the playbook for Callaway Topgolf?
Yeah, it's a great question. I do think M&A over time will be a part of the growth story here. This has been something that CEO Chip Brewer has really done for the last 7 or 8 years at Callaway, buying some apparel brands years ago, then more recently Topgolf. I'm not sure kind of where the M&A will look like. Last year, Topgolf Callaway brands made an equity investment in a company called 5-Iron. That is an indoor kind of driving simulator type concept. So obviously they've had an interest there. But I do think M&A will likely go forward. And I think the competitors you speak to just speak to the durability that we're seeing in the golf industry. There's been a revival of the game. Really, this started pre-COVID. I think there's a misconception that the game was kind of declining into COVID. We had seen a couple of years of growth into COVID. COVID fueled that. And I think these other concepts that are growing just speak to the resilience and kind of the positive outlooks for the industry over the coming years.
How significant did COVID, though, impact the growth of the game?
Materially. It would, definitely a big uptick in things like participation. But I think when we look at the companies here, what we like about them is, I would argue a lot of those transitory golfers during COVID, frankly, maybe didn't show up on the P&Ls as much as some investors may think for these companies. Golf as an industry historically is very top heavy. The top 15% of golfers are almost 70% of dollars spent each year. So it's a very enthusiast driven game. And so what I think is encouraging is what we're seeing is some of those transitory golfers, while we're losing some of them, some of them are converting into dedicated players, spending more per year. And I think that's going to help grow the overall pie. So it's been a nice, I think, ongoing tailwind.
Want to touch on the other I mentioned, Acushnet Holdings. Who are they? Why the price target and rating?
Yeah, it's a great question. So Acushnet, many of you likely know their brands that are Titleist and FootJoy being their largest at the majority of their product portfolio. They're an industry leader in categories like golf balls and consumables like shoes and gloves. I think for us, when we look at the stock here, just the valuation for the growth versus the growth prospects, I think it's probably a closer to mid-single digit type grower in a normal year, maybe gain a little bit of share, but more industry type growth. And I think the valuation's more full there versus something like a Topgolf Callaway brand.
All right, well, there's the good news. The bad news is Tiger 2 over, and Rory McIlroy is trying to complete the career Grand Slam, struggling as well. There goes my bets. Daniel Imbro, good to see you. Thanks, my friend. Enjoy the Masters.